what's going on, everybody? We're doing a little sound check right now. We'll get rolling here at 6 o'clock. If y'all would, please shoot in the little chat box just to let me know that you can hear me. We're doing a little sound check. We'll get rolling here at 6 o'clock on the dot. I want to thank everybody for coming on tonight. Okay, the sound is working. We'll get rolling at 6. Thank y'all. Hey, good evening, everyone. We got a big crowd tonight. I want to thank everyone for hopping in, hopping online tonight. We're going to talk about taxes and retirement. The world has changed since we've talked to a lot of people. The world is changing daily. We don't know what's going to happen with this coronavirus, and we're going to talk a lot about a lot of stuff tonight. I first want to welcome everyone for hopping on. Richard Berry, the founder of Berry Financial Group, will be on here tonight. He has his CHFC, which stands for Chartered Financial Consultant designation. He's got his CLU, which stands for Chartered Life Underwriter designation. He's got his CLTC, his Certification Long-Term Care designation. He's been doing this over 33 years. With Berry Financial, we manage over $500 million. And we've got 3,000 amazing clients. And it's just a blessing and a gift to be able to do these webinars in today's technology age. My name is Reid Mathews. I have my RICP, which stands for Retirement Income Certified Professional designation. And I'm also a Certification Long-Term Care designation. I was a baseball player for Coastal Carolina, and all I knew was baseball until before I arrived on campus. I had my first of what would be 4 wrist surgery, so my baseball career was ended. So I knew I needed to look for a career, and I was very passionate about money. And I called up Berry Financial Group for an internship, and I did not know this at the time, but Richard and Jan have a beautiful daughter named Jana who began hitting on me as soon as I started working, and I absolutely fell in love with her. We've been married going on 4 years. It's been the biggest blessing of my life, no doubt about it. But I'm glad y'all are here tonight. First and foremost, I want to start tonight by just reading some of my favorite verses, because we're praying for everybody during this time. I mean, a lot of people are shut up inside and being quarantined, which are some scary times, and let alone all the people that are suffering through the illness. And some of my favorite verses during this time are Joshua 1:9. Be strong and courageous. Do not be afraid. Do not be discouraged, for the Lord your God will be with you wherever you go. That's by far what I need to hear right now, especially with what's going on. Psalm 56:3. When I am afraid, I put my trust in you. And Proverbs 3:5-6. Trust in the Lord with all your heart and lean not on your own understanding. In all your ways, submit to him, and he will make your path straight. Now, Richard Berry is going to start us tonight with an opening. So y'all please help me welcome Mr. Richard Berry.
Thank you, Reid. Listen, I want to start out by saying I know we're in the midst of the storm. You know, I get asked almost every day, Richard, when do you think economically we're going to come out of this? How long? What's it going to look like? And here's the thing, I don't have a clue, but I want all the viewers to know I know who does. And I think we need to be very careful. You know, what we just saw last week, we saw 3.3 million people that applied for unemployment benefits. And what I've seen the last 3 days, I've seen the stock market recover some of its losses. And that's that's incredible. I mean, year to date, I think the market's down about 17% after today. But here's the caution I want to give you. This storm is not over. The impact of this COVID-19 financially and what it's going to do to this country is going to take a long time before we recover. And the best way I want you to kind of take a look at this is that if you live in Myrtle Beach, you understand that we have storms all the time and the potential storms of hurricanes. And when a hurricane comes off the ocean, you know, the front part of the storm, typically the winds aren't as severe. And so as that storm is approaching, you know, we all get very concerned, even with a level 1 storm. But what happens is that then we go to the eye of the storm. And what you see is the rain ceases, the sun comes out, and the winds die down. It's the back part of the storm that does most of the damage. And that's the point I want to make here. We're not going to know the full-blown damage in terms of what this COVID-19 has done to our economy. What we do know, it has shut down this country. It's cut out the knees out from under so many businesses. And that really leads into where we're going tonight, taxes in retirement. I'm going to make a lot of statements and pretty much validate a lot of the things that we're going to say tonight in terms of why you need to be very proactive in terms of what you're going to do in the future. Here's what I do know. There are a serious number of issues that must be considered over the next decade in order for you to make wise investment choices for the future. I know taxes will go up for most people in this country in the future. And what I also know is that the benefits are going to go down. And so if taxes are going up and benefits are going down, that means that we're going to have more out-of-pocket expense by the consumer. And so if you got the consumer having to pay for more, then guess what? They're not going to be able to buy as many consumer goods and services. Well, think about the impact that that's going to have on all these companies. So if we can't buy the goods and services, these companies that everybody investing in, their earnings are going to go down. And guess what? The stock price is going to go down. So I think we're in for a real rocky ride in the future. What I also know is that with all the challenges that we're facing, the U.S. government will not be able to raise taxes enough to fix the countless challenges that I'm getting ready to talk about. Think about it. If government raises taxes too much, that would absolutely destroy our economy and the world economy. And then you can't raise taxes to the point that people aren't willing to work and and to create. That's the last thing we want to do. And then you can't reduce benefits too much either, because if you do, you'll destroy the middle class. The middle class is already under duress. The middle class typically carries everything. And so what I want to do is I want to point out the real challenges that we're facing and what you need to do in order to be prepared for these challenges. Now, first of all, think about what our national debt is. We're currently around $23.5 trillion national debt. The interest on the debt alone is close to $500 billion. And, you know, we've got this stimulus package that Congress is trying to pass. That's going to be maybe roughly $2 trillion. So we're growing the debt with good reason, by the way. There are a lot of families, there are a lot of people that need help that can't pay their rent, they can't put food on the table. And so I'm just going to tell you, I'm happy that things are being done in Washington, okay? But the fact of it is, the way we're growing this debt, in 5 years, the interest on the debt will probably somewhere close around $1 trillion. Well, what's a trillion? I don't really know what a trillion is, but here's what I do know. The federal government has a budget right now about $4 trillion. And so if we're talking that the interest on the debt in roughly 5 years being $1 trillion, that's a fourth of our budget. Also keep in mind too, there's a lot of other issues. The student loan debt is around $1.7 trillion. The credit card debt in this country is $1 trillion. And we're going to have bailouts left and right. We're going to have to bail out the airline industry. We're going to have to bail out the cruise line. You know, we're helping small business. The federal government is, they're helping small business owners basically bail out. And we got another major crisis that not many people are really talking about, but we've got an energy crisis going on in this country. We've got Saudi Arabia and we've got Russia, that what they're doing is they're overproducing oil right now. And they've got this battle going on. And it's great for every American that's filling up their car with gas at the pump. But what it's doing is, it's because there's such a gluttony of oil and gas that's out there, it's absolutely hurting our energy companies, and some of them will go bankrupt. A few more things I want to point out. And listen, this is not about just trying to tell you everything that's bad in the world, but because I want you to know this is the best, we are the best nation in the world, period. There is so much opportunity that we have in this country. And the thing about it is, well, everything that I'm going to tell you, if you're set up correctly, you won't have to worry about these issues. The Social Security and Medicare trustees just issued a report, and they said Social Security reserves will be depleted in 2035. In 2020, Social Security for the first time is running a negative cash flow. So we don't have enough tax revenue coming in to support what's going out the door. Medicare will become insolvent in 2026. And then if you look at our aging population, there are currently 79 million baby boomers, 60 million Gen Xers. And so in the next 27 years, we're going to have 140 people over age 65. Think about it. Where will we have enough money? Where will we get the money to care for the 140 million people that's coming our way when we can't even, we're struggling to care for the 62 million right now? See, the government's going to need more revenue. And the question is, where will the revenue come from? Before you answer that question, I want you to understand some other things about our country. Keep in mind that 50% of the people in this country make less than $30,000. 2/3 of the people in this country make less than $50,000. And 50% of the people in this great nation pay no taxes whatsoever. So I'm going to throw this back to you again. Where is the government going to get the money to deal with all these major challenges that we're facing as we're going into the future? Well, I know where they're going to get it from. Number one, they're going to increase taxes. That's going to happen. And I really believe taxes are on sale. Number two, they're going to monetize the debt. What that truly means is they're going to print the money. Listen, the only way we can stay in the game at this point in time is that we have to keep printing money, keep printing money. Normally, when you print money, a lot of times what will come into play is that inflation will start going up. And then when you're printing a lot of money, the value of the dollar goes down. So what are the real repercussions of the money going down? It means that, again, we can't purchase as much consumer goods and services. And so the companies that offer those goods and services, they're not moving stuff off the shelf. So their earnings will eventually go down. And guess what the stock price will do? It will go down too. Now, if you understand the challenges that I'm talking about, and if you're positioned correctly, you and I and Reid, we can take advantage of certain strategies that will protect the money against taxes and market losses. And that's what Reid is going to come in and talk about. You know, I've been told by a lot of people, and I've been told in my life, knowledge is power. But see, knowledge is not power unless you do something with what you know. So I'm going to have Reid to come back in right now, and he's going to go through this process of taxes in retirement. And then what we'll do at the end, if we have time, we'll do a Q&A and see if we can answer any questions for you. So I'm going to have Reid to come back in right now.
Awesome, awesome, awesome. What a powerful intro. And once again, thank y'all for hopping online. We got the biggest crowd that we've ever had. So what a blessing. And let's jump into some of this really cool tax stuff, because I've been teaching some of this stuff for 2 years now. It's a lot of really cool stuff. So let's jump in. And first and foremost, of course, we got to go over some disclosures and different things like that. If you see in the bottom left, you can go to www.barryfg.com/schedule meeting. That'll be up there the whole time through these different slides. If you are interested in talking with me or Mr. Barry about some of these tax strategies we're going to discuss tonight, go in with www.barryfg.com/schedule meeting. Another disclosure, we're not CPAs. We are not CPAs. We partner with a great CPA that is directly across the street. There's a lot of great CPAs and tax preparers out there. So we are not CPAs. We know enough about taxes to potentially save y'all hundreds and thousands of dollars. That information that we share tonight could potentially save y'all hundreds and thousands of dollars. So let's jump in. The beginning of taxes. Congress imposed its first personal income tax back in 1861 to help pay for its war effort in the American Civil War, and this income tax was repealed in 1872. Then what happened? The 16th Amendment was ratified in 1913. This is literally what it stated: the Congress shall have power to lay and collect taxes on incomes from whatever source derived. Let me stop right there. From whatever source derived. If I work for the IRS and I know that the IRS literally stands for Internal Revenue Service, what I really want to know is that I can tax any income source from whatever service or whatever source derived. So they can literally tax any income sources except two streams, which we'll talk a little bit about. Tax rates. In 1913, Congress enacted an income tax levying a 1% tax on net personal incomes above $3,000. However, they had a 6% surcharge on incomes above $500,000. In 1913, that was a ton of money. But what we saw right there is that the people who have the money are going to pay the most in taxes. What Mr. Berry said earlier is 50% of people pay no taxes. So with the revenue sources that we're going to need, do you think we're going to get that revenue from people, the 50% that don't pay any tax, or the 50% that have a lot of money in this country in pre-tax accounts? Well, fast forward 5 years, because by 1918, the top rate of the income tax increased to 77% on income over $1 million. So that top percent went from 7% in 1913 to 77%. The top marginal tax rate reached 94% in 1944. 94%. In tax years 1944 through 51, the highest marginal tax rate was 91%, went to 92 for 1952, and reverted to 91% years 1954 through 63. Mr. Berry said it earlier, tax rates are on sale. Let's look a little bit more about the history, because to get where you want to go, a lot of times you got to go back to where people have already been. And these are some of the tax rates based on history. We see that huge spike that we just talked about in the 40s. Why? It was right after World War II, right? We needed more revenue. Well, a lot of people are considering the coronavirus a war. So what do you think may happen when we need more revenue after what we consider are a war against the country with the virus? Well, we know back in World War II, they increased tax to 90%. I don't know if they're going to get there or not, but what a great opportunity to pay taxes at low rates and reposition it to where you or your family never have to pay taxes again. Let's go over a few more statistics. The coronavirus relief package will be over $2.5 trillion. Current U.S. debt's over $23 trillion. Mr. Berry read a lot of these stats earlier, so I won't spend too much time on these. Tax brain teaser. Let's start off with a little brain teaser. We've got Bill. He's retired. He's got taxable income of $42,475. That puts him in the 22% bracket, because if we look at the 2020 single filer tax brackets on the right, a $42,000 taxable income puts him right in the 22% bracket. Well, of that $42,000, that includes $38,000 of IRA income plus $25,000 of Social Security. So his income is over $60,000. However, he only reports $42,475. That sounds really good, right? Well, Bill wants to go to a concert. He wants to go hear Hootie and the Blowfish. He's a country music guy, and he wants to tap an extra $1,000 from his pre-tax account for a concert road trip. How much will he owe in taxes on that extra $1,000? What do y'all think? I mean, he's in the 22% bracket. So it makes sense if he's got to take out $1,000, he should owe $220, right? Well, here's what he actually had to pay. $407 in tax, a 40.7% tax rate on that $1,000 alone. this gentleman named Bill in this example paid 40% tax. He paid $407 in taxation on that $1,000. How in the world does that happen? I ask this question a lot. Well, do you think Bill was wealthy? Everybody says no. Bill was bringing in 60 grand, only having to show 40 of it as taxable income. So do you think he was wealthy? No. Then how in the world did he pay 40.7% taxes on that income? Well, I'm glad you're here tonight because I'm going to show you how. And just remember, you can go to www.barryfg.com/schedule meeting if you do want to meet with myself or Mr. Barry. And our goals tonight, understand what happened with the Tax Cuts and Job Acts of 2017. Understand what that really means to your retirement income streams, and then identify tools and strategies available to people and retirees. The Secure Act, let me get this out of the way too. The Secure Act is a big deal. Instead of having the required beginning age for required distribution set at 70 and a half, as of January 1st, 2020, they pushed it to the year you turn 72. So you will have to take out your required minimum distribution a little bit later, the year you turn 72. Well, that's a good thing. If we skip to number 3 with earned income, you can now contribute to an IRA past the age of 70 and a half. That's new with the Secure Act. So if you are earning income, you can contribute past the age of 70 and a half. Well, what they did with number 2 was they took those 2 goodies and then they really made it good for themselves, because the stretch IRA is going away for many beneficiaries. What that really means is your biggest pre-tax account, if your child inherits it or your children, they'll have to spend that down within 10 years. Well, let's do some simple math. If you got $1 million in that pre-tax account, let's say you've got 1 child, and just on average, they'd have to show another $100,000 a year on their taxable income for 10 years and get that 100% out of your retirement account. That alone is going to generate $16 billion with a B of revenue to the IRS. My parents were very confused with this stuff. They didn't understand it. They tried to research it. I was trying to help them out with it. I told them what to look at, what websites. They just didn't get it. These people are not my parents, by the way. I have no idea who these people are, but they sure look confused. And if you see the 2020 married filing jointly brackets, I showed a quick example of Bill, who is filing as a single taxpayer. But for the rest, for the short time we got, I'll focus on the married filing jointly brackets. The concepts are the same. The difference is the numbers. And so I always ask this question is, do you think it's more favorable to file taxes as married filing jointly or a single taxpayer? It's married filing jointly, no doubt about it. So that brings up something called the widow's tax. If you are married or if you're filing taxes as married filing jointly, when one of y'all dies, now the living one has to file taxes as a single taxpayer. Well, here's the widow's tax. You may say, Reid, yes, that's true, but the single filer will lose a Social Security check. That's true. Probably part of a pension. That's true. The widow's tax is that living person will be receiving less income, but have to pay more in taxes. These are the brackets of 2020. It goes 10%, 12%, 22%. By 2026, we know that the rules before the tax cuts are going to sunset. What that means, what's 12% now in 2026, assuming no changes, will go back up to 15%. Well, that 22% now will go back up to 25%. What's 24% now will go back up to 28%, assuming nothing happens in 2026. We got about 5 to 6 years to really do some cool planning if that's something you are interested in. However, if you've ever done an actual tax form, you understand that we have a progressive tax code, meaning only the thin income is taxed at that particular tax bracket. What do I mean by that? Well, the first bracket you're looking at on the screen is 0 to 19,000. That's a 10% taxable income. So if we look at that next bracket, anything from 19,751 all the way up to 80,250 is taxed at 12%. So let's say we've got somebody bringing in 30,000 of taxable income. Question, do you think the full 30,000 is taxed at that 12%? The answer is no. How you calculate it is you take the 30,000 minus the 19,700, so you're looking at about 10,000. Only that 10,000 is taxed at that 12%. The rest is taxed at the 10% or even falls in that beautiful standard deduction. So this is a tax map. This is what this PowerPoint is going to be based a lot on, something called an ordinary income tax map. These are the income brackets. We have the software to show these tax map, and when we're doing tax planning, we use this software. Well, what do you see right here? You see the 10 and the 12%, then the 22%, and so on and so forth. Where's the biggest areas of planning? The 12% bracket. Hands down, the 12% bracket is one of the biggest areas of planning. Why? That very next bracket is at 22%. Well, 12 to 22 doesn't sound like a whole lot higher. That's almost 100% higher. So if you're wanting to do some tax planning, wouldn't it make sense to stay within that 12% bracket so you don't increase your taxes on that next $1,000 by 100%? No doubt about it. Well, a lot of people are already in that 22 or 24% bracket, and there's nothing they can do about it. Their Social Security is what it is. Their pension is what it is. They're already taking out the required distribution. Well, how cool is this? The next area of planning, why not max out that 24% bracket? We know by 2028, that bracket's going to go back to 28%. And that 24 to 32%, that's like a 30% increase. So when you're doing the tax planning, if that's something you're interested in, then it's very important to max out that current bracket that you're in. Let's talk about marginal tax rates. That's the tax bracket your last dollar falls into. In that example, with the person making 30,000, their marginal tax rate was 12%. Capital gains and qualified dividends, do they get special treatment? Yes, no doubt about it. Capital gains get special treatment. Does anybody know what the capital gains brackets are? Well, let's look at them right now. Here's the capital gains brackets for 2020. How cool is this? If your taxable income is from 0 to 80,000, and this is big, we just established earlier that 2/3 of Americans make less than 50,000. So if your taxable income is 0 to 80,000, including your capital gains, you will pay 0% in taxes on those capital gains. 0%. See, the reason that some people did this back in the day, or from 2009 to just a month ago, we were in the longest bull market we've ever seen, 11 years. It literally lasted 11 years without a 20% drop. But some people said, well, I've got these gains, but I don't want to sell. I don't want to sell because I don't want to have to pay the taxes. Well, guess what? You don't have that gain anymore. So you definitely don't have a tax problem. But what somebody should have been telling you is anything from 0 to 80,000, you don't pay any tax on capital gains. And then from 80,000 to 496,000, you only pay 15%. That is peanuts in the scheme of things, especially where tax rates back where they were behind World War II. So what a great time to sell. And so a lot of times what a lot of people keep in their pre-tax accounts, have it invested in stocks, mutual funds, bonds. Well, you don't get the capital gains treatment if you hold those positions inside your 401ks or IRAs. That's a big deal. So it makes no sense to hold stocks and bonds and equity positions inside of pre-tax accounts just from a sole tax standpoint, because anything that comes out of those accounts is taxed as ordinary income. If you're going to hold stock positions or equity positions, it makes sense to have it in an after-tax vehicle where you can get those capital gains treatments. And remember, go to www.barryfg.com/schedule meeting to get some of this cool tax planning. So here's the long-term gain capital or long-term gain and dividend tax map. Deductions. That's basically the pure definition is an amount deducted from your taxable income. With the tax cuts of 2017, they doubled the standard deduction. They literally doubled it. 85% of people today will file taxes using that standard deduction. 85%. They've actually increased it $800 since then in 2017. So the standard deduction for married couples is $24,800. Well, what about the mortgage interest on debt over $750,000? Can you write that interest off? No. Now that affects a very small percentage of people because most people don't have mortgages of $750,000 or more. But just a little fun fact is that's what's hurting some of these cities out in California. Why? Everything they got out there is well over $1 million. So in the past, someone could buy a home in California, pay a lot of monies, and get to write off a ton of interest. Well, they took that away. So a lot of towns in California, the people are moving across the state to Nevada, which is interesting. Charitable gifts of cash or check up to 60% of income. You know what's interesting is if you're using that standard deduction, you do not get a direct write-off of your charitable gift. If you are using the standard deduction and you're still giving, you're not getting a direct write-off for that charitable gift. So which brings me up to one of my points, something called a qualified charitable distribution. A qualified charitable distribution. This is huge for people that are of the age where they're having to take out a required minimum distribution. Let's look at an example. Let's say you're 73 and your required distribution is $10,000 and you file that standard deduction, but you're also giving $5,000 to the local church. You don't get to directly write off that $5,000. However, this is a qualified charitable distribution. Let's say that money is invested with Fidelity, and Fidelity is the one that sends you your $10,000 every year. You need to stop that right now. You need to say, hey, Fidelity, don't send me the full $10,000. Take $5,000 of it, send it directly from you straight to the church. You get to write off 100% of that $5,000. So if you're in that situation where you're receiving a distribution and you are filing the standard deduction and you're giving, that is a huge wealthy play to get 100% write-off. And then additional deduction for being 65. Yes, you get an additional deduction for being the beautiful age of 65. Being 65's gotta be cool. I mean, it's gotta be cool. You go on Medicare, you get an additional deduction. They say being 65 is the new 50. I don't know if that's true or not, but it sounds good. I hope it is for a lot of people. Exemptions. You get an exemption for being alive. About 14 or 15 months ago, my brother-in-law and his wife had a baby girl named Caroline. So she's 15 months now, I believe, and absolutely beautiful. My sister and her husband had a baby boy about 9 months ago. He's beautiful. And they're a lot cuter than this baby that's on the screen. So let's get this baby off of there. No, you do not get that personal exemption anymore. It really hurt a lot of people, specifically the Duggars. You know, the whole 19 and counting thing. They were getting a ton of write-offs. They don't get that anymore. This is my nephew, Reese. He lives over in the UK across the pond. And then this is my beautiful little niece, Caroline. So you can call me Uncle Reid. I am Uncle Reid. I'm absolutely loving it. This little boy and this little girl have rocked my world, no doubt about it. Credits. Let's talk a little bit about credits. This is where a great CPA is worth their weight in gold, by the way. When you're talking credits, you're talking the nooks and the crannies. You're talking the right paperwork. The numbers got to be just right. So please find yourself a very good CPA or tax preparer that you feel confident in. Healthcare tax credit. To get this credit, you typically have to have very low income and typically high health expenses. If that's you, talk to a tax professional. You may be able to get a tax credit. And all a credit is literally a reduction in your tax bill. So a deduction, you get to write it off before you even file taxes. A credit is saying the federal government says, hey, you owe us $5,000, but here's $1,000 credit. Now you only owe us $4,000. That's the difference. Earned income tax credit. Are most retirees earning income? No. Most retirees are retired, so they don't get that one. Education credits. Are most retirees going back to college? No. They say you get to go back for free, though. Just for attending tonight's webinar, we're going to give you a $2,000 education credit. Don't tell your CPA to call us, though. We're not answering on that. Savers credits. Are most retirees saving money? No, you should be spending it. That's why you built it. And then the last one, the child credits. Do most retirees have young children? No. Maybe you should, though. Maybe you should. Some of y'all had some of that baby fever. Let me pull them back up there. Okay, let's get off of that. Let's get off of that. Now let's look at an example. We've got a married filing jointly couple with gross income of $38,000. Then you apply that minus deduction of $24,800. Then they get an additional deduction of $1,300 per person. If you're single, it's like $1,650. But married filing jointly is $1,300 per person for being over 65. They get to deduct $27,400. That is huge. That is absolutely huge. Then these people contribute $2,000 to an IRA. So what do we know about these people? We know they're working. We know they're working. So now you get to write that off. They show $8,600 of income subject to tax. That puts them in the 10% bracket. They owe $860. Then they get $1,000 tax credit for contributing to the IRA. Boom, they don't pay a penny in taxes. $38,000 of income and don't pay a penny in taxes. Now, if that's all it was, it'd be pretty simple. But the reason we're holding this webinar tonight is because the real tax system. When you bring in required minimum distributions, capital gains, Social Security benefits, Medicare premiums, if you show too much income, do you think you pay more for Medicare? No doubt about it. Medicare is means tested. It's probably going to get more and more and more means tested with some of the deficits. Potential Roth conversions. Y'all got to come back next week, next Thursday, April 2nd, to learn about Roth conversions. But here's the skinny on it. Had a lady come in, it's been 2 years ago now, and she had $130,000 in her pre-tax account. Never paid taxes, had $130,000, never paid any tax on it. She had like $10,000 in a Roth IRA. She was 65 at the time, and this was when the required distribution was 70.5. She said, Reid, I'm kind of concerned about having to take monies out at 70.5. I'm concerned about them increasing taxes. What should I do? We ran a little tax map, and I showed her how she could convert about $30,000 a year from her pre-tax account to her Roth. Does she pay taxes on the conversion? Yes. Well, with the tax map, we were maxing out that 12% bracket. She was cool with that. She was absolutely cool paying 12% brackets. She believes tax rates are definitely going to go up. Tax rates are on sale. So let's fast forward 5 years. Now she does pay taxes, 12% on the conversion, but after 5 years, let's say she's 70.5 or 71 now. She's got no monies in her pre-tax account, but now her Roth IRA is 150 grand. Well, at 72, do you think she has to take monies from that $150,000 Roth IRA to satisfy a required distribution? No, she does not. Well, let's say she doesn't need the money at the time, and now from age 72, it's $150,000. Let's say she lives to 80 years old, very reasonable in today's world. And let's say that $150,000 grows to $250,000. And now let's say she wants to go buy a new car. She wants to go buy that new truck, that GMC truck that you can lift down the back and then stand up in it, and it's looking like stairs, and it does like 20 different things. That's amazing, by the way. And she wants to go buy that. And she wants to pay cash for it. Well, my goodness, here in probably 10 years, that truck alone is going to be probably $175,000. So let's say she takes $175,000 out of her Roth IRA to pay cash for that truck. Do you think she pays tax on that $175,000? No, she doesn't. Well, it gets better. Let's say she doesn't do that. She's really leaving a legacy. She wants this money to go to her family. And let's say she's one of these amazing women that live to be 95, like 1 out of 3 women are going to do. So she lives from 80 to 95, and let's say that $250,000 grows to $700,000, and then she dies, and her children inherit $700,000 of a Roth IRA. Do you think they pay tax on that $700,000? No. Do you think I saved that lady hundreds and thousands of dollars? The longer she lives, the more money she saves. And see, the thing is the power of that. The Roth IRA is an amazing tool, and we're going to talk a lot about it next week. But the power of that's not the Roth. The power of that is the time. See, if you're already spending your money, it may not be appropriate to do the Roth conversion. But if you're a little ways away from spending, or if you're wanting to leave it for a family member or for your wife or spouse, then it very well could be a wonderful strategy. How do required distributions work? Well, you have to take them out the year you turn 72. So what they do is they look at the prior year's ending balance and then divide that number by your remaining life expectancy. Well, let's look at this example right here. And let's say I turned 72 this year. And so this is the year I got to take out my first required minimum distribution. What they do is they look at the balance of my account on December 31st of 2019. Well, let's say it was 500,000. Based on my life expectancy, I've got to take out 18,248. If I don't take it out, it's a 50% penalty. 50%. Your problem's not taxes at that point. But what's interesting is it's a 50% penalty, and then they make you pay tax on the other 50%. Well, let's say I've got 5 IRAs, $100,000 each. Do you think I can take out 100 or all 18,000 from one? Yes, I can. Well, let's say I've got $250,000 in an IRA and $250,000 in a 401k. Can I take it all out of one of them? No, I've got to take it out one of each. See, what we do a lot of and really help people is consolidation. Some people got 3, 4, 5, 6, 7 different retirement accounts. It's a nightmare. It is an absolute nightmare. So we do a lot of consolidation to make people's lives simple. Because a great question is, do you want your life more simple or more complicated in retirement? You want it simple. So remember, www.barryfg.com/schedule meeting to look at a lot of these cool strategies. This is a life expectancy table. The required minimum distribution percentage gets higher as you get older. You've got to take out a higher percentage as you get older. Why? The government knows you're closer to dying and they want their tax money. So some people have been taking out required distribution for 5, 6, 7 years and it stays around the same. Well, here's what's going on. Your account balance is going down, but the percentage is still going up. Here's the good news. You're paying about the same in taxes. Here's the bad news. You're on your way to going broke. And let me look at one more example. Let's go back here. On December 31st, that balance was 500,000. Well, what if that balance, that 500,000 is invested 50% stocks and 50% in bonds, right? Which is what 90% of advisors have their clients in. And now let's say that 500,000 after a 20 to 35% drop in the market like we've seen is now 350,000. Do I still have to take that full 18,000 out of now my current account balance of 350,000? The answer is yes, and you're on your way to going broke. So see, if you're already receiving distributions, if you don't have some positions, that guarantee you can't lose any money. In a downward market, you will spend your account far faster or down far faster than if you've got a safe alternative where you can't lose any money, which is where Berry Financial really specializes in. Is Social Security taxed? This is the most confusing part of my presentation. How do you consider if it's taxable? This is the very first step you do. You calculate what's called your provisional income. How you calculate that? You take 50% of your Social Security, you add in any ordinary income, you add in any dividends and capital gains, and then you add any non-taxable interest, specifically municipal bonds. This does not count Roth IRAs or cash value life insurance. So you take this number to determine if your Social Security is taxed. That's step number one, numero uno. Once you get that number, you apply these thresholds. So the single individual is $25,000. Anything above that, you take half of it. Anything above $34,000, you take the full 85%. Married filing jointly, anything above $32,000, you take half of it. Anything above $44,000, you take full 85%. That doesn't mean 50% or 85% of it's taxable. That's what you apply after those thresholds. Let's look at an example. We've got a married couple bringing in $20,000 of Social Security, and they pull out $40,000 of an IRA withdrawal. Their provisional income is $50,000. How did I get that? You take half of your Social Security, and then you take the full IRA withdrawal. So you take that $50,000 and you apply those first thresholds. 50,000 minus 32,000 is 18. You take half of that, that's 9. 50,000 minus 44 is 6,000. You take an additional 35% of that to get to the 85%, 2,100. So of these people's benefits of Social Security, their taxable benefits, 11,100. That's 55% of it goes on their tax return. It's not taxed at 55%. It just goes on their tax return. Let's look at another example. These people are bringing in 40,000 of Social Security, and then they take out 20,000 of an IRA withdrawal. So their provisional income's only 40,000. You apply the first threshold, which 40,000 minus 32 is 8. You take half of that is 4,000, and then they're not over the second threshold. Only 4,000 of their money of Social Security goes on their tax return. Please look how cool this is. The top people had $20,000 of Social Security, yet their taxable benefit was $11,100, 55%. The second couple had $40,000 of Social Security, yet their taxable benefit was only 10%. The second couple had 100%, not 5, not 10, not 20, 100% higher Social Security, and yet only has to show 45% less on their tax return. So question, could taking Social Security early at a lower rate cost you and your family a ton of money? Yes. Question, could taking your Social Security late cost you and your family a ton of money? Yes. If you're waiting to age 68 to turn it on and you die at 67, you lose. So there's no right or wrong answer, but from a tax standpoint, the bigger Social Security you can have, the better. So let's apply these thresholds. Once again, the first couple, we look at their tax return. They're bringing in, you got to show 11,100 taxable Social Security plus 40,000 of IRA monies. So their total taxable income is 51,100 minus that beautiful 27,000 deduction. So they have to show 23,700 of net taxable income, which they have to pay a couple $1,000s of federal income. They're bringing in 60 grand. The next couple is bringing in 60 grand. Yet how much tax do you think they pay? Remember, they got 100% higher Social Security, but have to show a lot less of it on their tax return. Here's how much tax they pay. 0. These people are bringing in $60,000 and are not paying 1 penny in tax. Do you think that'll ever be able to happen again? I personally don't. I personally do not think once everything shakes out with the deficits we're facing, that people will be able to bring in 60 grand and pay no tax, literally. Little bit about the Medicare premiums. If you show too much money, you will pay more. So we won't spend a whole lot of time on that. Our time is coming to an end pretty soon. So let's look at the effective marginal tax rate. How much of your last dollar do you actually lose to Uncle Sam? Let's look at an example. Here's the tax map again. If you go to www.barryfg.com/schedule meeting, we can get you access to a tax map. Here's what it looks like for an ordinary income. Here's what the long-term gain and dividend tax map looks like. So let's look at the example. We got a case study now, and this is how the real tax system works. Just remember Bill, the first slide, the little tax brain teaser, bringing in $40,000. He took an extra $1,000 out and he owed 40% in tax. Let's look at this example. We've got John and Jane, married, filing jointly. They're over 65. They're bringing in $60,000 combined Social Security. So they both waited quite a while, no doubt about it. They got $10,000 of net long-term capital gains. That's not a whole lot by any means. And then their required distributions alone are $52,000. So they definitely have some solid monies in pre-tax accounts, or they could be just 90-something year old where they got to take out upwards of 15% of their pre-tax account as a distribution. So what do you think their tax map looks like? Here is what it looks like. They start out at 18.5%. Reid, you spent this whole time telling me to maximize the 12% bracket. Did these people ever reach the 12% bracket? No. They went straight to 18.5%, straight to 22%, and then boom, jumped up to 49.95% tax on a certain portion of their monies. They paid 49.95% in taxation. Who do you think got that 50%? The IRS. And what do you think the IRS said to these people? Thank you. See you next year, right? How in the world did that happen? Well, let's look at it. What do we think should happen? Because these people are in the 12% bracket. You think you take out $1,000 and then boom, there's my $120, 12%. Here's what actually happened. They pulled out $1,000. They paid 12%. But that $1,000 caused an additional 85% of their Social Security to be taxed at 12%. Then that additional $850 of taxable Social Security caused an additional $1,850 of capital gains to be taxed at 15%. Bingo, 50% to the IRS. Here's what's interesting. These people can't do anything about it. Their Social Security is what it is. Their long-term gains are peanuts in the scheme of things, $10,000. Their required minimum distributions are what they are. They're taking out the bare minimum. So if this can happen to these people, do you think it could happen to you or your family here in the next 20, 30, 40 years? No doubt about it. No doubt about it. This is their capital gains. They paid capital gains tax at 10% and then 38% on some of their capital gains. The IRS has a lot of people right where they want them. And what we're doing at Barry Financial is trying to reposition some of these monies while tax rates are as low as they possibly will be, and put them in positions to take forever taxable money and turn it into never taxable money. An American judge wrote this: anyone may so arrange his affairs that his taxes shall be as low as possible. He is not bound to choose that pattern which will best pay the Treasury. There's not even a patriotic duty to increase one's taxes. An American judge wrote this. Do you think these billionaires do tax planning? Do you think Warren Buffett does tax planning? Do you think Hillary Clinton does tax planning? Do you think the Donald does tax planning? They asked the Donald, this has been about a year, they said, Donald, or they said, Mr. President Trump, man, you're bringing in a couple $2 billion and you didn't pay any taxes. Why? What was his response? because I'm smart. That was his response. The tax code is designed to help you, not hurt you, but you got to play by the rules, and you got to find some people who know how to play by the rules, which we believe we do. So go to barryfg.com/schedule meeting. This is me and my wife and Chance, my golden doodle dog, on the left. We've got Mr. Barry, my beautiful mother-in-law, Mrs. Jan Barry, and their awesome black poodle named Zoe. So that's who you heard, Mr. Barry, at the beginning. You heard me throughout this process. And please join us on Thursday, April 2nd at 6 p.m. to discuss the importance of Roth IRAs and life insurance. The two strategies to bring in tax-free money to you and your family are Roth IRAs and cash value life insurance. That's it. We will talk about this on Thursday, April 2nd at 6 p.m. and what you need to do to create tax-free money for you and your family. Remember, www.barryfg.com/schedule meeting. Referral opportunities. For those of you that are clients, we do all those dinner seminars at Ruth's Chris. Mr. Barry's built this business doing it. It's been a wonderful place for the clients to come and bring their friends. Well, they shut down the restaurants for a couple months. We've had to cancel our April and May dinner seminars, which is why we're doing some of this stuff virtually. And we want to give you that same opportunity. So forward the webinar link to your friends and family. Make sure they put your name down when they sign up. That's very important. We got to know who referred them. What you'll get is the extra tickets to our client appreciation event. We rent out the whole Carolina Opry for our clients every year. We've been doing that for over 10 years. Last year, we had 1,400 people come out. It was amazing. We see the Christmas show at the Carolina Opry. We give away iPads, Kindles, manicures, golf outings, massages. You get extra tickets for referring somebody to put into those potential for prizes. Then you get potential for winning season tickets to the Carolina Opry and a gift card. So we believe in referral opportunities, and that's a big deal. It's a great way to say thank you because we love our clients. Without them, we wouldn't be here. So our goal is to serve them. You know, we've got a great saying, our passion is helping people with their money. That is our passion, helping people with their retirement money, but our purpose is to love people the way that Jesus Christ did. And that is from the honest truth. Barry Financial's been giving retirees and pre-retirees peace of mind through safety since 1987. Mr. and Mrs. Barry have done an incredible job of building a firm who takes care of people the right way. And that is our goal. And thank you so much for coming on tonight. We talked a lot about a lot of stuff. So we couldn't get into too much specifics. It was a very quick hour. So please go to www.barryfg.com/schedule meeting. We'd love a chance to speak one-on-one and see if there's any value that we can give. And please be there for next Thursday at 6 p.m. where we really go through the details to get tax-free money. I just want to thank everybody for coming on. We love y'all. Y'all have a blessed night and stay safe out there.